Welcome to the visual guide to Elliott wave trading. In this video, we'll explore how the Elliott wave principle can be used to identify, assess, and manage trades in financial markets. Whether you're a seasoned trader or just starting out, understanding the wave principle is essential for finding high-confidence setups and improving your trading discipline. We'll walk through real-life examples, discuss the psychology behind trading, and provide actionable tips for risk management. Let's begin our journey into the world of Elliott wave analysis and discover how this approach can transform your trading results. Wayne Gorman and Jeffrey Kennedy are the minds behind this comprehensive guide. Both have extensive experience trading for a living, using the Elliott wave principle as their primary discipline. Wayne has managed trading desks at major banks and heads educational resources at Elliott Wave International. Jeffrey handles daily educational and trade identifying services at EWI. Their combined expertise ensures that this guide is not just theoretical, but grounded in practical, real-world trading scenarios. Their willingness to share both successes and mistakes makes this book a valuable resource for traders seeking authenticity and actionable advice. Robert R. Prichter, Jr., founder of Elliott Wave International, provides a foreword that sets the tone for this guide. He emphasizes that successful trading is not about finding perfect setups on paper but about navigating real market challenges. Wayne and Jeffrey's approach is honest, showing both the difficulties and rewards of trading. Prichter reminds us that trading requires discipline, effort, and knowledge. This guide aims to provide that knowledge, helping you decide if trading is right for you and how to approach it with realistic expectations. The visual guide to Elliott wave trading is designed for easy navigation and practical use. Charts are presented in full color and large format, making them accessible and clear. The book includes video tutorials, definitions, key points, quizzes, and pop-ups for terminology. For Bloomberg terminal users, there's a cheat sheet summarizing relevant functions. This multi-format approach ensures that readers can reinforce their learning and apply concepts directly to their trading routines. The Elliott wave principle is a method for analyzing market cycles and predicting price movements. It assumes that prices move in recognizable patterns, called waves, which repeat at different scales. The guide assumes you have a basic familiarity with these patterns, but provides a refresher in the appendix for those needing review. If you're new to Elliott wave analysis, free resources are available online to help you build foundational knowledge before diving into advanced trading strategies. Analysis and trading are distinct skill sets. Skilled analysis involves mastery of observation, identifying patterns, and understanding market structure. Successful trading, however, is a mastery of self, managing emotions, discipline, and risk. Recognizing this distinction is crucial. You may be a talented analyst, but trading requires additional skills, including psychological resilience and risk management. This guide will help you develop both so you can become a consistently successful trader. There are 5 core Elliott wave patterns: impulse wave, ending diagonal, zigzag, flat, and triangle. These patterns form the basis of all trade setups. Motive waves, impulse, and ending diagonal define the direction of the trend, while corrective waves, zigzag, flat, triangle move against the trend. Identifying these patterns quickly and confidently is essential for finding trading opportunities and positioning yourself in the direction of the larger trend. Motive waves drive the market in the direction of the dominant trend. There are 2 types: impulse waves and ending diagonals. Corrective waves, on the other hand, move against the trend and include zigzags, flats, and triangles. Even if you only identify whether a wave is motive or corrective, you can find useful trade setups. This distinction helps traders buy pullbacks in uptrends and sell bounces in downtrends, a proven strategy for consistent success. The wave principle offers several advantages over traditional technical studies. It identifies the trend, countertrend moves, maturity of the trend, high-confidence price targets, and specific points of invalidation. Unlike moving averages or oscillators, Elliott wave analysis provides context, history, and future projections, helping traders make more informed decisions and manage risk effectively. A 5-wave advance signals an uptrend, while a 5-wave decline indicates a downtrend. Trading in the direction of the dominant trend is easier and more consistent than trying to pick tops and bottoms. The saying, "the trend is your friend," holds true in Elliott wave analysis. By focusing on the dominant trend, traders can avoid the pitfalls of countertrend trading and increase their chances of success. Countertrend moves are typically 3-wave patterns known as corrections. Recognizing these corrective waves, zigzags, flats, and triangles allows traders to buy pullbacks in uptrends and sell bounces in downtrends. This strategy helps traders rejoin the dominant trend and avoid low-confidence setups. Understanding countertrend patterns is a key component of successful Elliott wave trading. Wave patterns are fractal, meaning they repeat at different scales. This repetition helps traders determine the maturity of a trend. For example, if prices are advancing in wave 5 of a 5-wave sequence and wave 5 has completed several smaller waves, it may be time to take profits or raise protective stops. Recognizing trend maturity prevents traders from entering late and helps them manage risk more effectively. Elliott waves adhere to specific Fibonacci proportions. Motive waves are often related by equality, 1.618 or 2.618 ratios. Corrections typically retrace a Fibonacci percentage of the preceding wave. These relationships allow traders to set profit-taking objectives and identify areas where price turns are likely. Using Fibonacci-derived regions enhances confidence in trade setups and helps define risk and reward. Wave analysis provides specific points of invalidation, levels where an interpretation is no longer viable. For impulse waves, 3 cardinal rules apply. Wave 2 can never retrace more than 100% of Wave 1. Wave 4 may never end in the price territory of Wave 1. And Wave 3 can never be the shortest among Waves 1, 3, and 5. Knowing these rules helps traders set protective stops and recognize when a trade setup has failed. Waves 3, 5A, and C are the most advantageous to trade, as they move in the direction of the larger trend. Trading in the direction of the trend is the path of least resistance. The wave principle helps identify these high-confidence trades, allowing traders to focus on setups with greater probability of success. By combining Elliott wave analysis with traditional technical studies, traders can further enhance their results. Figure 1.7 illustrates bullish and bearish trade setups. In both cases, corrective waves 2, 4, 5, and B introduce the 4 primary Elliott-based trading opportunities. These setups allow traders to rejoin the larger trend by buying pullbacks in uptrends and selling bounces in downtrends. Understanding these setups is fundamental for trend trading and maximizing your trading potential. Corrective waves offer less desirable trading opportunities due to their complexity and erratic nature. Impulse waves are trend-defining and typically travel far, while corrections move sideways and can be deceptive. Trading corrections can be emotionally exhausting and risky. However, in longer time frames, corrections may offer short-term opportunities. It's important to assess the duration and structure before considering trades in corrective waves. Before trading specific Elliott wave patterns, remember the rule: let the market commit to you before you commit to the market. Look for confirming price action to decrease overtrading and focus on higher confidence setups. Waiting for confirmation helps avoid premature entries and increases the likelihood of successful trades. These guidelines are essential for disciplined trading and risk management. When an impulse wave is complete, enter on a break below the extreme of wave Roman 4 of 5. This technique prevents top picking and requires the market to confirm the end of the impulse wave. Set the initial protective stop at the extreme of the price move. This conservative approach ensures evidence-based trading and reduces risk. For ending diagonals, wait for a break of the extreme of wave 4 before entering a position. Place the initial protective stop at the extreme of the price move. Aggressive traders may enter on a decisive close beyond the trend line connecting waves 2 and 4. The protective stop remains at the extreme of the pattern. This approach balances conservatism and aggression, depending on your trading style. For zigzag patterns, enter on a break of the extreme of wave Roman 4 of C, provided this level is beyond the termination of wave A. Alternatively, wait for the extreme of wave B to give way before entering. The initial protective stop is the extreme of wave C. This conservative approach prevents picking tops or bottoms without sufficient evidence. In flat corrections, the final wave subdivides into 5 waves. The recommended entry technique is to wait until prices exceed the extreme of wave Roman 4 of C before entering a trade. This approach is not used with zigzags as the structure differs. Waiting for confirmation helps avoid premature entries and increases trade reliability. Triangles are sideways price moves bounded by converging trend lines and subdivide into waves A, B, C, D, and E. The entry guideline is to wait for prices to break the extreme of wave D and place an initial protective stop where wave E terminates. Aggressive traders may enter earlier, but triangles can be deceptive, so caution is advised. Risk management is critical for trading success. The risk-reward ratio compares expected returns against the amount of risk taken. A high risk-reward ratio is desirable, as it increases profitability even with lower win rates. The recommended risk on a single trade should never exceed 1 to 3% of the total portfolio size. Professional traders embrace small risks to ensure longevity and survive losing streaks. How large a position should you take? Never risk more than 1 to 3% of your portfolio on a single trade. This conservative approach allows you to weather losing streaks and maintain trading longevity. If your account is small, trade fewer contracts or penny stocks. The key is to keep risk small relative to your total capital, ensuring you can survive and thrive over time. Psychology is the true key to trading success. Factors such as lack of methodology, discipline, unrealistic expectations, and patience can sabotage results. Whether you're a professional or a beginner, understanding how your personal psychology affects trading outcomes is essential. This guide helps you recognize and overcome psychological pitfalls so you can trade with confidence and consistency. A defined trading methodology is essential for consistent success. Write down your analytical tools and how you use them. Whether you use Elliott wave, point and figure charts, stochastics, RSI, or a combination, clarity is key. If your methodology can't fit on a 3x5 card, it's probably too complicated. Simplicity and clarity help you recognize buy and sell signals and manage trades effectively. Once you've defined your methodology, discipline is required to follow it. Inconsistent application leads to poor results. The formula for success is to consistently apply a proven methodology. If your approach changes frequently, you either lack a defined system or the discipline to follow it. Focus on consistency and adherence to your trading plan. Unrealistic expectations can sabotage trading results. Aim for realistic goals, such as not losing money in your first year. In subsequent years, try to beat market benchmarks like the Dow or avoid falling for advertisements promising outsized returns with minimal risk. Focus on steady progress and risk management for long-term success. Markets trend only about 30% of the time. High-quality trade setups are rare, so patience is essential. Avoid overtrading by waiting for compelling opportunities. Remind yourself that another trade of the year will always come. Focus on quality over quantity and maintain discipline to avoid chasing lesser setups. To reinforce your understanding, answer these true-false questions. 1. Analysis and trading employ the same skill set. 2. Wave analysis identifies the direction of the trend. 3. The wave principle offers points of invalidation. 4. Wave 2 can retrace more than 100% of wave 1. 5. A complete Elliott wave cycle consists of 9 waves. 6. Waves 2 and 4 offer high-confidence opportunities. 7. Aggressive ending diagonal entry waits for wave 4 extreme. 8. Confirming price action lets the market commit to you. 9. Zigzag entry guideline is to wait for wave B extreme. 10. A risk-reward ratio of 1:1 is ideal. Let's analyze a real trade setup in Caterpillar CAT. In April-May 2011, prices fell in 5 waves, signaling a downtrend. The subsequent 3-wave rally retraced 50% of the sell-off, a common corrective retracement. Applying Elliott wave analysis, the odds favored another move down. The trading plan involved buying 110 puts, aiming for a short-term move below the previous low. Managing the trade, the position was exited for a 336% return. Recognizing impulse and zigzag patterns combined with Fibonacci ratios led to a high-confidence setup. In March 2012, Techncorp Tech showed a possible expanded flat pattern. A 3-wave advance followed by a 3-wave decline suggested either an expanded flat or running triangle. The trading plan was to sell 100 shares on a move below the extreme of wave Roman 4. Managing the trade involved adjusting protective stops as price action unfolded. The trade yielded a 3.38% return over 7 days, demonstrating the power of recognizing wave patterns and disciplined risk management. Analyzing the Australian dollar in early April 2008, a 3-wave decline subdivided into 3 smaller waves, forming a double zigzag labeled WXY. This structure indicated the larger trend was still up. The trading plan was to buy futures at 0.9180 with a protective stop at. The upside objective was 0.9430, where wave 3 would equal a 1.618 multiple of wave 1. Managing the trade involved monitoring price action and adjusting stops as the trend unfolded. Throughout these trading examples, managing protective stops is crucial. As prices move in your favor, incrementally lower stops to lock in profits and reduce risk. Prior swing highs or lows, often second or fourth waves, make suitable protective stops. This approach ensures you protect open profits and minimize losses, following the 3 phases of risk management: lessen risk, eliminate risk, and protect profits. Price gaps occur when the current bars range does not include the previous bars range. In Elliott wave analysis, gaps often form in wave 3 positions, especially in wave 3 of wave 3. Technicians classify gaps as breakaway, acceleration, and exhaustion. Recognizing gap types helps traders understand momentum and trend strength, aiding in decision-making and risk management. After each trade, review your actions and outcomes. Ask whether you could have entered earlier, exited better, or managed stops more effectively. There's no right or wrong way to trade, only your way. The key is to learn from each experience, refine your methodology, and maintain discipline. Profitable trades, even if modest, contribute to long-term success. Elliott Wave trading combines pattern recognition, risk management, and psychological discipline. By identifying motive and corrective waves, setting realistic expectations, and managing risk, traders can improve their results. The guide emphasizes evidence-based trading, patience, and continuous learning. Use the wave principle as your framework for history, context, and future projections. For further learning, visit the exclusive Reader Resources site. Access a free online edition of Elliott Wave Principle by Frost and Prichter, lessons on wave analysis, and tutorials on trading specific patterns. These resources help deepen your understanding and provide practical tools for real-time application of the wave principle. The visual guide series includes video tutorials to show concepts in action. Watch videos on identifying high-confidence trade setups, managing risk, and understanding the importance of patience and persistence. These tutorials reinforce key ideas and help you apply Elliott wave analysis effectively in your trading routine. The guide includes a glossary of Elliott wave terms and definitions for key concepts. Understanding terminology is essential for clear communication and effective analysis. Refer to the glossary for explanations of patterns, ratios, and trading guidelines. This resource supports your learning and ensures you grasp the foundational language of Elliott wave trading. For Bloomberg terminal users, the guide provides a cheat sheet summarizing relevant functions for Elliott wave analysis. This resource streamlines workflow and helps traders access key tools quickly. Integrating technical analysis with Bloomberg functionality enhances efficiency and supports informed decision-making. Wayne Gorman and Jeffrey Kennedy bring decades of trading experience and educational expertise. Their backgrounds in managing trading desks and providing daily trade-identifying services ensure that this guide is practical and reliable. Their commitment to sharing both successes and mistakes makes this resource authentic and valuable for traders at all levels. The guide includes an index for easy navigation and a section on educational resources. Use these tools to find specific topics, review key concepts, and access additional learning materials. Continuous education is essential for mastering Elliott wave trading and staying ahead in the markets. Elliott wave trading is a journey of observation, discipline, and self-mastery. By applying the principles outlined in this guide, you can enhance your trading performance and achieve consistent results. Remember, there's no perfect way to trade, only your way. Stay disciplined, manage risk, and keep learning. Thank you for joining us on this exploration of Elliott wave trading.